All right, looks like we are at the top of the hour here, so I'm going to go ahead and get things started. First, just a couple of housekeeping items to get out of the way. Uh, in case I'm moving a bit quick here, and you want to be able to revisit anything that's covered into today's presentation, we will be sending out both a recording and the slides at some point in the next 48 hours. So be on the lookout for those. Second, to find any of the recent webinars that we've offered here at the Federal Home Loan Bank, please access the resources page on the main Federal Home Loan Bank website. Yeah, go there. You can find any of those previous webinars. So with that out of the way, I want to welcome you all to part two of FHL Bank Topeka's Practical Guide for Community Financial Institutions series on stablecoins. So for those of you that don't know me or that I haven't had the chance to meet yet, my name is Sam Thomas, and I'm an analyst in the Strategy, Innovation, and Planning Department here at the Federal Home Loan Bank. I want to start off by thanking everyone who joined us at our annual members conference back in April for part one on this topic. We had a lot of great questions and dialogue that stemmed from that session that gave us here at the bank, a lot of things to think about as we continue to monitor this space. Also, the ratings and feedback on that session actually helped to develop some of the content in today's presentation. So thank you to everyone who took the time to fill those surveys out. They really do help us to build and improve on our educational material for you all. For those of you who weren't able to join us at AMC, which based off the initial signups I saw is well over half the people in here. First off, sorry that we missed you, but I hope that you are able to join us next year where we'll be back in Kansas City with another great week of speakers and activities. Secondly, don't worry, we will still be spending time today going over some of the more foundational aspects that we covered in part one. So that means whether you're a return learner or brand new to stablecoins, you'll still leave today armed with what I think is a good baseline understanding of the fundamentals. So with that said, let's quickly look at what it is that we'll be discussing today. And I want to start things off here with a little bit of context. So one of the main focuses of my department, as the strategy part of the name might suggest, is to be looking ahead, seeing what's on the horizon, and developing strategies that help us either mitigate or take advantage of these trends to better serve you, our members. And right now, one of the biggest developments that's driving our work in that area is this topic of stablecoins or digital assets. I think it was around September of last year that my manager came to me and said, hey, Sam, we've got a bit of a knowledge gap in this area. Do you have any interest in taking on a research role? And I can say that since that time, I have truly been drinking from a fire hose while trying to learn everything that I can on this topic. I will also say that, before now, I was very much a skeptic, but admittedly did not know much about blockchain outside of the big and usually pretty negative headlines. So you might have heard of things like Silk Road, the meme coin rug pulls, even the collapse of Silvergate Bank and Signature Bank. It was these stories that led me, probably like many of you on this call, to think that this was just a space for one of two things, that being either get rich schemes or illegal activity. And to be honest, as I've researched more on it, that really was sort of the case when it came to the financial applications of blockchain for much of its existence. The core functionality of blockchain technology just logically lends itself to these types of use cases. So we'll get into all of these elements when we take a closer look at some of the risks. But for starters, blockchain is by nature anonymous. So most public blockchains don't show real names. Bit of a misnomer there, but instead they show a line of letters and numbers that tell you where a stable coin is going or where it came from. Two, blockchains are generally decentralized. So this means that there's virtually zero oversight. So if something goes wrong, there's no institution immediately responsible for fixing it. Three, activity recorded on its ledgers is irreversible. So no chargebacks, no dispute resolution, which for legitimate users is kind of a nice safety net, but for bad actors, it's kind of like a getaway car in the shape of a rocket ship. And then lastly, and this is less about its functionality and more just sort of an unfortunate truth, but that's that blockchain technology is really, really complex. So full transparency, I am not the world's most tech savvy guy. I know enough to be dangerous, but even when I'm talking with people who I consider to be the most tech savvy in my circle about blockchain, they either flat out don't understand it or struggle to put it into words that you or I could begin to understand. So there's a very big reason why the engineers and the devs who are fluent in this stuff are in such high demand right now. And that's because it is inherently hard to understand. So I'm starting out by saying all this because whenever I tell people that my life now kind of revolves around cryptocurrency, which stablecoins are, this is where people's minds instantly turn to. That conversation usually begins with cryptocurrency. So like Bitcoin, I'm like, well, sort of. And, we'll talk a little bit about the differences there. And then they'll eventually turn to how they bought Dogecoin when Elon Musk was tweeting about it, and that they didn't end up making a dime because Robinhood froze all of their trades. And then in the end, after what I would deem a lengthy, productive conversation on the topic, I'll hear, yeah, I don't know, Sam, it still just doesn't make any sense to me, man. So volatility, rug pulls, too confusing. This is the uphill battle that stablecoins are fighting and the lens and frame that most people view them through. So even with all its differences from other cryptos, all the legitimizing developments over the past couple of years, and all the adoption by big finance that's really wholesale changing the way that money is moving, it's these views and these experiences that need reorienting if stablecoins are really to catch fire, in my opinion. So if what I just talked about sounds kind of familiar, it's okay. You're not alone, but hopefully after we're done here today, I've done enough to convince you that stablecoins are worth your time, or at the very least worth your understanding. So how are we going to do that? First off, as I mentioned at the start, we're going to establish or reestablish the fundamentals. So like I just alluded to, many of you may have heard the term stablecoin, but may not fully understand what differentiates them from other cryptos like Bitcoin or how they function. So we're going to cover that in full. We'll also look at how stablecoins are predominantly being used right now, and then how the regulatory developments have led us to where we are today, particularly with respect to the Genius Act and the Clarity Act. We'll close out this section with what matters most to you, the community institutions, and that's the practical implications. So this will include both the opportunities and associated risks that stablecoins present to your shops today. If you joined us in April, this section should act as a good refresher. And if you're just joining us for the first time today, then this section will give you the baseline knowledge and context needed for the rest of today's discussion, and then any additional webinars that we may have down the line. Next, we'll dive into some of the more recent developments that were either in flight or yet to materialize when we last spoke. So though we still have nothing concrete, there has been continued debate in Washington on the fine print of the Clarity Act. So I'll provide some insight into what it is we're hearing there. There's also been a number of proposed rulemakings and interpretations published by various agencies related to the Genius Act. So we'll quickly run down what those are and what they could mean going forward. And then to conclude our session, we will close out with what I'm calling the hashing it out bonus round. So again, as I said at the beginning, we received a number of questions or requests for additional information following the April presentation. I've since scrubbed that feedback and built out an FAQ, or in this sense, a fascinating asked questions list that I believe are probably most top of mind for most of you on this call. And then after answering those questions to the best of my ability, I will then give you all a list of questions that are keeping me up at night. So you can take those back to your institutions and start to unpack those. These FAQs I'm going to call the frightening asked questions. Then if we have any additional time at the very end, I believe we have a traditional Q&A option available here within the Zoom call that I can pull from and shore up anything that might be lingering there. So if all of that sounds good, without further ado, let's kick things off here at the ground level with the most basic of concepts. So we've gone on here for a few minutes, and some of you might still be wondering what the heck a stablecoin even is or how it even works. So as I've shown here at the top, a stablecoin is defined as a digital token designed to maintain a stable value, typically pegged one-to-one to a fiat currency, which for our intents and purposes is usually the US dollar. I'll caveat this now. Blockchain and cryptocurrency love to use fancy language and heavy jargon, which I think contributes to a lot of the fear and confusion around the topic. I'll be breaking down this definition into more layman's terms that hopefully we can all understand, but just know that you're probably going to want Google or Copilot handy as you get further down this whole rabbit hole. So starting with a digital token, this means that stablecoins are blockchain based and operate on what we call distributed ledger technology. So it's a mouthful, or DLT. So there's a reason that they put that into an acronym. As you can see down below, this is also our first key characteristic of stablecoins, and a rather important one. So since stablecoins live on a blockchain, transactions are generally immutable. So this means that they can't be changed. And they also don't require certain traditional payment rails to operate. So this includes things like SWIFT, correspondent banking, ACH, traditional wire transfers, all essential to the way that money moves today, but also all potentially removed from the equation with the advent of stablecoin and DLT. Breaking down our definition one step further, we have designed to maintain a stable value, which is also second here on our list of key characteristics, that being price stability. So unlike other cryptocurrencies like Bitcoin, which can swing in value by thousands of dollars in either direction every day or even every hour, a stablecoin aims to stay at exactly one of whatever asset it has been designed to represent. So, like I said, most commonly and most practically for our purposes, that is the US dollar, but there are also euro-backed stablecoins, Japanese yen-backed stablecoins, and even gold-backed stablecoins. So that takes us to the second half of our definition, typically pegged one-to-one to a fiat currency. And to help visualize this one-to-one aspect, I'm going to jump ahead a slide real quick because there are actually 4 different types of stablecoins that exist on the market today, with the main difference being exactly how they maintain that one-to-one peg. So the first 2 we just touched on, that being fiat and commodity or gold-backed stablecoins. But you also have crypto-backed stablecoins that use other cryptocurrencies like Bitcoin to act as collateral. And then we have what are known as algorithmic stablecoins. And these use the programmability aspect of the blockchain to manage supply and demand in real time. And as a result of the Genius Act that was passed in July of last year, the details of which we'll get to here in just a second, only one type of stablecoin is able to be considered a payment stablecoin, and that's those that are fiat backed. So this is accomplished by the issuer holding actual dollars or dollar equivalent assets in reserve and then issuing stablecoins one-to-one against those reserves. So right now, any stablecoin on the market that isn't designed in this way must convert, or it risks losing its ability to operate within the broader US financial system. So the deadline for that is a bit of a moving target right now, and mostly relies on final regulator rulings, but it won't be any later than January of next year. So that is our definition of stablecoin in a nutshell. We already touched on these first 2 key characteristics, but real quick on these last 2. First, we have redeemability, and this is important because nearly everyone on this planet uses some other form of payment right now besides stablecoins. So the ability to redeem your stablecoins for dollars or whatever your native currency is really paramount in order to be relevant. There may come a time where down the line, once stablecoins are more widely adopted, this mechanic isn't quite as important, but for now it's more or less essential. And then lastly is this idea of programmability. So this is really a huge unlock, in my opinion, that gives stablecoins an advantage in certain financial applications. So through blockchain features like smart contracts, you can program conditional situations like if X happens, automatically send Y stablecoins to Z address. So this introduces automation into the payment space that's really pretty difficult to replicate through more traditional methods. In a world where everyone's looking for ways to process improve and squeeze out every ounce of efficiency through automation, this is really an attractive feature and why you're seeing faster adoption by companies that are already operating on a 24/7, 365 basis. So moving on to our next slide, why have stablecoins become such a hot topic right now? What has been driving the hype around stablecoins in the last 12, 18 months that's motivated us to talk about them today? So first, I want to start with a brief history lesson. Here we have a chart of the total market cap of all stablecoins from when the first stablecoin was minted all the way back in 2018 up until today. So I don't know about everyone else on this call, but definitely came as a shock to me when I found out that the first stablecoins came to exist more than 8 years ago. But for those first couple of years, stablecoins really were just used as dollar substitutes on exchanges to facilitate the trading of other cryptocurrencies. So this is when traders were keeping their dry powder, so to speak, in stable coins, and then using them to buy and sell the often more volatile Bitcoins and Ethereums of the world. So still very early in the world of all cryptos, which meant that there really wasn't a ton of volume at that time. Then starting here in 2020, you had what's known as the DeFi boom. So this is when there was a surge of market entrants looking to participate in the rise of crypto, which caused all things related to cryptocurrencies to really take off. So it's kind of a high tides raise all ships sort of situation. So since stablecoins served as the on-chain unit account, this required greater and greater volumes to meet the general growing demand of crypto. So at this time, over the course of 2.5 years, from early 2020 to the middle of 2022, outstanding stablecoins grew from roughly 10 billion to nearly $200 billion. So massive, massive growth. Then came May of 2022, when we had what is known as our first major depegging event. This is when a stablecoin, for one reason or another, is no longer valued at exactly $1, which happened with one of the more major stablecoins at the time, known as Terra Luna. So Terra Luna was actually designed as an algorithmic stablecoin, which we just talked about, and to this date serves as the poster child for why this type of stablecoin is not allowed under Genius. So in less than a week after losing its peg, it wiped out more than $45 billion in total value and sent the entire world, the entire crypto world, into a bit of a tailspin. But note that the bottom did not just drop out of stablecoins. Even though crypto-backed and algorithmic stablecoins might have struggled to kind of find their footing, the demand for those that could reliably maintain their $1 value actually increased. So it was during these next 2 to 3 years, as crypto legislation started to be drafted, that you saw a shift in the market and an eventual rise in the two main stablecoins that continue to dominate the market today, those being Tether's USDT and Circle's USDC coins. So these were the two most prominent, primarily fiat-backed stablecoins at the time, and eventually served as the models for what would be required by the Genius Act, which takes us to July of 2025. And that's where the reason for why we're talking about stablecoins today, to me, really starts and ends. And that's with the passing of the Genius Act. So for these first few years, the regulatory treatment of stablecoins was largely patchwork and really pretty ambiguous. And it was the lack of trust and unknown risk that stemmed from this regulatory treatment that had most institutions reasonably choosing to avoid stablecoins altogether. But that all changed with the passing of the Genius Act. So Genius was the first major federal legislation specifically targeting stablecoin regulation that established the basic framework that everyone is now operating under. We'll get into this in greater detail here in just a second, but for now, just know that the Genius Act really was the catalyst for everything that we're talking about here today. And then next is the Clarity Act. So even though the Genius Act really started the institutional stablecoin movement, it still left a slew of questions open to interpretation that Clarity is now trying to answer. Most importantly being how stablecoins differ from other digital assets, and then who has jurisdiction over how those involved in its circulation must operate. So we'll dive into the specifics of Clarity here in a second as well. But what I mainly want you to take away here is that if and when we finally get the Clarity Act passed, we will have actual legislation creating actual guardrails that many have been waiting for before pursuing stablecoins. So here I have the short list of reasons why I think we need to be paying attention to these things. And first is the regulatory momentum that we just discussed. But then second is the culmination of what we just walked through, and that's that's this sheer market scale. So over the past 2 years, we've seen the stablecoin market cap more than double, up to $320 million plus, which brings them in aggregate to the second largest cryptocurrency behind Bitcoin. Now, industry research expects this number to continue growing at or beyond this pace once we get Clarity passed. So no longer just some niche technology experiment, but a real market with some real scale. And then lastly is the growth in both institutional and consumer adoption. So between payment processors, fintechs, global banks, we've seen a rapid influx of stablecoin participants through integration into their settlement flows. So it's seemingly every other week that you hear about a new partnership between a credit card company and a fintech. typically either a crypto exchange or a digital bank. And it's these partnerships that are enabling the younger generation and small businesses to open digital wallets and make on-chain payments. So these huge companies are making big bets that that's a lasting trend. So to me, that screams that this is where the movement of money is probably ultimately headed. I'll note there are studies out there that the current raw stablecoin transaction volumes aren't nearly what's being reported, but rather just the internal shuffling of funds or the repeated movement of the same capital within some of these institutions. But my guess is it's only a matter of time before everyone's hands are more or less forced to get involved here, simply because those at the top of the food chain say so. Uh, lastly, on the more fundamental side of things, is some of the major use cases that we're currently seeing right now. With the first and still most dominant use case being for crypto trading. So, as I noted on the timeline, since its inception, stablecoins have served as the primary unit account for traders who want the convenience of being on chain without the inherent price risk that comes from holding other cryptocurrencies. Then the other somewhat related use case to crypto trading is the ability to participate in what are called DeFi protocols. So this is where things get really technical and jargony, but think of it more or less as the infrastructure that enables financial services to be automated on the blockchain. So the rise of crypto-related activities that I have listed here is in part why stablecoins took off during the DeFi boom back in 2020, as they actually served as payment for those that are maintaining the blockchain. But that's as far as I'm going to go, and where I'll turn you to your favorite search engine if you want to dive in any further there. Next, and where stablecoins have really started to go mainstream, is its a utility in cross-border payments and remittances. So where traditional wire transfers can take days to process, are loaded with fees, and require institutions on both sides of the transaction to be open, you can instead use stablecoins that settle in seconds, are available 24/7, and move end to end with very minimal fees. So think of them in this sense like your favorite email provider, but you're sending money rather than silly cat videos. Our fourth use case, and this goes hand in hand with remittances, but it's the adoption of stablecoins as a store of value in emerging markets or countries dealing with crippling levels of inflation. So say you live in Venezuela or Argentina and someone wants to send you 100 US dollars, you are far better off receiving that money in stablecoins where you can maintain that balance in something dollar denominated rather than instantly having to convert to your local currency where it will inevitably lose purchasing power overnight. Then lastly is this emerging use case of handling cash flows for things like corporate treasury management, as well as B2B and C2B payments for the same reasons that we just discussed. It's instant settlement, 24/7 availability, and programmability. So suppliers are willing to accept payments in stablecoin because they get paid instantly instead of having to wait for things like ACH or check clearing. And then same goes for consumers. If I'm holding stablecoins for trading purposes, I don't necessarily want to have to go off chain just so that I can pay for daily expenses. And vendors are rising to that moment and adjusting to meet that demand. So whether it's accepting stablecoins as a valid form of payment or the credit card companies providing that conversion process as a service behind the scenes. So these are just a couple of the use cases that we're starting to see more and more of, and more specifically with this last one tied to cash flow management, where you all might start encountering stablecoins through your customers, be it those who want to accept stablecoins, those who want to make payments in them, or those that want to just simply hold them as part of their own treasury management. So these are all very realistic possibilities with examples of which already exist. Excuse me. Okay, so now that we know what stablecoins are, how they work, and what they're used for, I'm going to turn our attention to the regulatory front. So starting with the Genius Act, which for those of you who love long, convoluted acronyms, stands for the Guiding and Establishing National Innovation for U.S. Stablecoins Act. So as I said earlier, it passed in July of last year and served as a catalyst for broader adoption by establishing the basic framework that everyone's now operating under. More specifically, though, it mandates what's required of stablecoin issuers to ensure that they're operating the right way through four key provisions that we have listed here. So first, it defined who can issue stablecoins. All issuers now fall under one of three categories, which includes insured depository institutions, state chartered trust companies with adequate capitalization, and then federally licensed stablecoin issuers. And this is a new category of non-bank entities that must meet certain criteria. So this is significant as institutions now have explicit permission to issue stablecoins if they meet the requirements. Whether you want to is a different question, but the door to legally do so is now open. Second, it created a federal regulatory pathway for stablecoin issuance. So this is where the reserve quality requirements we talked about comes into play. Rather than relying on the requirements of the state money transmitter licenses and interpretations, the Genius Act laid out the standards and said, this is how your stablecoin must function if it wants to be considered a permitted payment stablecoin. Third is it established operational standards. So this includes things like mandatory regular audits, certain rules around custodial services, and then best practices as it relates to risk management. And then lastly is language around consumer protections. So as we know from our key characteristics on the first few slides, redeemability is massively important to the viability of stablecoins. Genius established clear redemption rights, meaning if you hold a stablecoin, not only should redeemability be possible, but you now have the legal right to redeem it from the issuer for dollars at par value. Genius requires the disclosure of reserve composition. So as an issuer, your quality of reserves is under the scrutiny of both your auditors and those who hold your coin. Genius also builds in certain fraud protections and establishes liability standards if the issuer fails to honor those redemptions. So that's kind of the 10,000-foot view of the Genius Act. But in the end, just remember that it focuses on the stablecoin issuers. So that's who can issue stablecoins, how they can go about doing so, and then what is required of them related to issuance to ensure safety and soundness. So then anything beyond issuance, and that's where clarity comes in. So the naming convention here is a little less imaginative, just shortened from the Digital Asset Market Clarity Act. But what you should know on clarity is that it's primarily a market structure bill that is attempting to differentiate stablecoins from other digital assets and dictate how those involved in its circulation must operate. So not just issuance, but all the intermediaries that might touch a digital asset beyond that. And the way that it's attempting to do this is by first refining how federal law broadly defines digital assets. So this is looking at both stablecoins and other tokenized instruments and saying, what does it really mean to be a digital asset? Now, the answer here will ultimately determine which regulators have jurisdiction. So for the majority of digital asset types, that's either the SEC or the CFTC. But as far as stablecoins and you all are concerned, that will likely fall to the banking regulators. And then after rounds and rounds of regulatory interpretation, we'll have various sets of rule books that address a whole host of issues related to digital asset circulation. So this will include things like the raising of capital, anti-fraud and anti-manipulation requirements, additional custody requirements. But before I get much further on clarity, I'm going to transition real quick and close out the final few high points from April's presentation. The majority of our developments over the past couple of months are related to the political theater that's going on in Washington right now, as Clarity's supporters are doing everything that they can to get final language over the finish line. So we'll cover Clarity in a bit greater detail there. So let's for a few minutes turn our attention to the opportunities and risks that stablecoins present for you all. I'm going to start with the opportunities and more specifically how we are seeing institutions beginning to use stablecoins in their day-to-day operations. And then we can get into some of the more aspirational unlocks that are most relevant to you all going forward. So here I've got a beautiful diagram of XYZ CFI that will serve as our example community financial institution. I'll begin with some of the lower stakes ways that stablecoins could start to improve XYZ's internal operations, and then work my way up to the more predominantly customer-facing services. So first, and something that we've already covered to some degree, deals with the day-to-day operations that could benefit from 24/7 settlement. So this includes things like treasury management, collateral movement, emergency liquidity needs. Today, traditional banking mostly operates on traditional business hours, and things like ACH and wires don't operate on nights and weekends. So it's 5 o'clock on a Saturday and XYZ needs to move some money. They're probably waiting until Monday morning to get that done. That's where stable coins that do settle 24/7 and typically seconds can come in. I'll caveat, as I know that this isn't entirely a novel use case with FedNow also providing real-time settlement, but stablecoins can work across any blockchain-enabled counterparty without needing them to be in the FedNow network. So there are some advantages. Second is cross-bank transfers. So if XYZ wants to send money to ABC Bank, they typically need correspondent banking relationships. They either go through the Fed or use Swift for international transfers. But with stablecoins, they can just send everything on chain, no intermediary required. So the only limitation really is whether ABC Bank can accept stablecoins. This was actually JP Morgan's primary reason for creating their own coin more than 7 years ago. They wanted instant settlement between their own entities and institutional clients without the need for correspondent banks or central clearing. So third is for any transaction where there's considerable amounts of counterparty risk. So whether that be wholesale banking, things like security settlement or cross-border transactions. So in traditional clearing, there's multi-day settlement concerns. XYZ sends a wire, but final settlement might not occur until tomorrow or later. And during that window, there's counterparty risk. But since blockchain settlement is instant and final, the transaction either goes through or it doesn't. So there's no in-flight period where XYZ is exposed. I do recognize that the finality aspect of this also carries some risk. And there is some peace of mind that comes with a deferred batch-based approach like ACH that's worth noting. And again, this instant and final aspect is not a unique opportunity when compared to systems like FedNow or real-time payments. But FedNow and RTP also carry counterparty risk. And they also have reversibility concerns that rely on the counterparty's cooperation. And where stablecoins differ and ultimately excel, in my opinion, is where this last unlock comes into play. And that's the programmability functionality that we've been talking about. So anywhere XYZ currently has manual processes in their day-to-day operations, that could lead to either a fat-fingered extra zero or unauthorized payment. These processes can simply be programmed out with what are called smart contracts. So these are self-executing lines of code that automatically perform certain actions once a set of predefined conditions are met. So commands like verify the recipient before sending based off of this whitelist of addresses, or check the amount is within this allowable range before releasing them from escrow. This type of conditional logic can lead to payments that eliminate really any sort of manual intervention. So that means there's no need for multiple parties to confirm that everything's in order, and no blind trust in intermediaries to execute everything as XYZ has authorized. So those are just some of the more day-to-day operational efficiencies that stablecoins could unlock. Next, let's look at some opportunities with more customer-facing implications. So starting with the integration of stablecoin technology through partnerships with fintechs. And at the ground level, this probably looks much like how XYZ might have adopted other technological capabilities. And that's by turning to their tech vendors and leveraging their expertise. So core banking services are already providing stablecoin solutions through their own proprietary offerings. Between Fiserv, FIS, Jack Henry, they all have versions of their own stablecoin platforms. So rather than building their own blockchain rails, XYZ might just look to their core providers to simply turn on certain blockchain-based features. And then moving up a level, XYZ might partner directly with a stablecoin issuer or payment platform that needs a trusted banking partner. So the issuer has the technology, the distribution channels, and the customer interfaces, but they need someone to hold reserves, provide custody, or maintain accounts. XYZ provides the banking infrastructure in exchange for things like custody fees, transaction fees, interest on reserve, and then potentially gets access to new customer segments or revenue streams in the process. one more floor up, and where XYZ might actually introduce some blockchain technology of their own, is looking to integrate stablecoin custody and payments that ensures that their customer never leaves their platform. So instead of the customer setting up a stablecoin account through a crypto exchange, they do it directly through XYZ. XYZ handles the conversion from deposit accounts to stablecoins, and then they also facilitate payments. So this will probably require some level of partnership to provide the technical infrastructure, but from the customer's perspective, they're just using XYZ for secure storage and payments, which keeps XYZ in that flow. And then lastly, and by far the most complex approach, but also perhaps the most strategic, is white label issuance. So instead of partnering with someone else's stablecoin, XYZ can issue their own bank branded stablecoin, XYZ coin. The customers hold this stablecoin backed by reserves that they manage. They retain the deposits. They're just represented as stablecoins or tokenized deposits rather than traditional deposit accounts. So XYZ controls the life cycle of the coin at every stage. So I know I just threw a ton of things out there for you to consider, a lot of which probably sounds like it's light years away from ever being relevant. But just know that there are already examples out there of these situations at every level. So most importantly, however, is that in whatever way that you choose to engage, do so in a way that makes sense for you and your institution. You know the inner workings of your business and the wants and needs of your customers better than anyone else. So if the best thing for you to do right now is to just stay educated and watch how things shake out, great. But if you think there's opportunity, from everything that I've read, the advice is to start small, leverage your relationships with your existing tech partners, slowly build out your capabilities, and see how things go, just as you would with any other new internal process or product offering. So that takes us to the less fun side of our more strategic discussion, and that's the operational risks and compliance considerations that we should all be aware of. So this is by no means a full list of risks that need to be considered, but I do think it serves as a decent starting point for a more comprehensive risk assessment. Bringing back our friends at XYZ, first on our list of operational concerns is when they are functioning in the custodial capacity that we just talked about. So as is the case with other institutions today, if a customer loses a password, XYZ can reset it for them. If credentials are stolen, most of the time transactions can be reversed. And then on a more catastrophic level, if XYZ were to fail, FDIC insurance would apply and the customer would be made whole. But with stablecoins, all these scenarios potentially differ. So control of stablecoins is protected by what are known as cryptographic keys. And if XYZ loses these keys, the stablecoins are gone permanently and irrevocably. And then if someone steals the keys, they can transfer the stablecoins XYZ has custodied for their customer instantly and irreversibly. So this requires new security infrastructure. Things like multi-signature wallets, hardware security modules. And then we didn't get into this when discussing the Genius Act, but a notable omission in Genius from an issuer standpoint is that FDIC insurance does not apply to stablecoins. So if XYZ is the custodian of someone's stablecoins and something goes wrong, they are on the hook. Next is smart contract vulnerabilities. So this is where the programmability aspect of the blockchain we've been talking about can become more of a liability than an asset. If XYZ is using programmable features, they're relying on code, and code can have bugs and it can be exploited. So sometimes it's an unintentional coding error, or it can also just be a bad actor who creates intentional workarounds. Evaluating smart contract security requires technical expertise that most of us don't have in-house. So remember at the very beginning when I talked about the blockchain engineers and developers that are in such high demand? Well, those people aren't cheap, and they're not exactly in high supply either, and neither are the auditors that can evaluate their work. So our third operational risk is settlement risk. So despite stablecoin's claim of low cost, 24/7 instant settlement, there are certain instances where that's not always the case. During high congestion periods, transactions can actually be delayed. And then there are what's known as gas fees. So this is the term that we use to describe the transaction costs that are paid to those that maintain the blockchain. these can actually spike dramatically. And then last on our list of operational risks is counterparty exposure. So if XYZ is holding stablecoins issued elsewhere, they're exposed to that issuer and reliant on its solvency and operability. And though the regulatory progress that we've been talking about is helping to alleviate some of these concerns, attention still needs to be paid to the safety and soundness of these issuing companies. Poor reserve quality or fraud can still lead to things like depegging events or redemption failures, which, as we discussed, are concerns of the not too distant past. So then moving on to compliance risk, let's start with the BSA and AML requirements. So today, XYZ has established internal controls designed to ensure ongoing compliance with these two regulations. But transacting in stablecoins complicates things a bit, particularly because blockchain transactions are by nature anonymous. XYZ can see that wallet address A sent stablecoins to wallet address B, but they may not know who controls those wallets. So this makes transaction monitoring much, much harder. And then, traditional AML tools that look for suspicious patterns in customer accounts, these don't work the same way when transactions are potentially happening through self-custodied wallets. So this requires different tools. There are certain analytics platforms that can do things like trace transaction flows, identify high-risk addresses, or flag patterns that are associated with illicit activity. But these tools are very expensive and require expertise to use that effectively. There's also enhanced due diligence requirements. So if a customer wants to receive stablecoin payments, XYZ is going to need to understand where those are coming from. On the other hand, if XYZ's customer is sending stablecoin payments, they need to understand where those payments are going. So then second is KYC or know your customer requirements. Right now, XYZ knows who their customers are. The customer opened an account, provided identification, and XYZ verified it. But the anonymous nature of blockchain technology poses issues here too. So if a customer receives stablecoins from a wallet that XYZ has never seen, how do they verify that that's actually their customer's wallet? And then cross-border transactions are actually particularly tricky in this regard as well. So with stablecoins that move across the globe in an instant, XYZ's customer might be receiving payments from a counterparty in jurisdictions with weak AML controls or even active sanctions. Early regulatory guidance is that XYZ will need to apply the same KYC standards as they always have, but the mechanism for doing so is less clear when transactions are happening on a blockchain outside of their systems. Third is the difficulty of sanction screening. So OFAC maintains lists of sanctioned individuals, entities, wallet addresses, and XYZ is going to be required to screen against these. But what if they inadvertently accept stablecoins from an address that 3 transactions ago received funds from one of these sanctioned wallets? Does that mean that they are now in violation? This is going to require real-time screening capabilities. XYZ is going to need to be able to check every incoming wallet address before accepting transactions. They probably need to maintain their own block lists beyond just OFAC, and they need clear policies on what to do when they identify these problematic connections. And then, there's the reputational risk that comes with all of this. So even if XYZ is technically compliant, if it comes out that they processed stablecoin transactions or issued a stablecoin somehow connected to illicit activity, that's probably a news story that they're not going to want to be associated with. And then just the last thing that I want to touch on here is vendor oversight. So this probably goes without saying, but if XYZ is partnering with companies to execute on any of these opportunities that we just discussed, they need to be doing their vendor due diligence. Their regulators are going to expect them to have conducted appropriate third-party risk management, meaning that they'll need to understand their partners' controls, their financial conditions, as well as their compliance programs. So that's just a few risks to consider in a long laundry list that need to be weighed before jumping into the stablecoin space. We didn't get into liquidity and funding risk, credit and balance sheet risk, market risk, and so on and so forth. But what I most want for you to take away from this section is that all of these risks that we just talked about, all these risks that I just listed, these fundamentally are not new types of risk. And as community financial institutions, you are masters at managing risk. You have well-established risk practices and frameworks that you apply to any new product or service offering, and stablecoins should be no different. So don't let the fancy jargon scare you. Approach stablecoins as you would any other new venture. And if and when the moment arrives that you do choose to get involved, just make sure that you're armed with the information that you need to be successful. So that puts a bow on the more foundational concepts for today's discussion. At this stage, hopefully everyone understands the core building blocks of stablecoins, including what they are, how they work. We've talked about how the primary use cases, or talked about the primary use cases of today, and then the more speculative use cases of tomorrow. We also touched on the policy and regulation that has motivated stablecoin adoption and continues to shape the industry today. And then lastly, we discussed how a CFI might look to start getting involved and what some of the risks are that you need to be considering before doing so. So if you weren't able to join us at the AMC in April, you missed out on some of the more firsthand accounts that I shared that probably gave this section a bit more meat to its bones. For right now, though, I wanted to make sure that we're all on the same page before we go any further on the topic, while also giving the part one crowd some new information to think through here in a second. Also included in that April presentation were some suggestions on what you could be doing now to prepare so that stablecoins don't become a bigger liability down the line. I'm actually working on beefing that section out into a short reference guide that you can print out and review or share at your next board meeting. So if you would like me to share that with you once it's finalized, I have my contact information available at the very end of this presentation. Like I said, we also have a recording that you can then come back and reference this with. Please don't hesitate to reach out, and I'll make sure that you get included on that distribution. All right, so we've got about 15, 20 minutes left. I'm going to try and blaze through this, but let's talk through some of the more recent developments in the stablecoin space that are making headlines today. So I'll start by circling back to the Clarity Act. So we began our conversation here by noting how Clarity differs from Genius and what it's attempting to answer, that being how various digital assets are defined, which then dictates which regulatory body's rulebook will ultimately apply. So I'm going to do another quick history lesson, as I think the context under which this is all happening today is really pretty important. So as Clarity was originally written back in May of 2025, and the way it read when it was passed in the House 2 months later, this really was the focus of the bill. Clear jurisdictional boundaries between the SEC and CFTC, and then a federal oversight blueprint for the intermediaries involved. But since the House vote, where it passed with overwhelming bipartisan support, the Senate has been working on its own version. And after months and months of deliberation behind the scenes, the Senate Banking Committee releases a 278-page draft in January that went far beyond the House bill. So this shifted the focus from defining who will ultimately write the rules to language around things like banking activities and software developer protections. So attempting to resolve issues far beyond the original scope of the House bill. And now, despite months of negotiation, the Senate has yet to hold a final markup. Like I saw, they're supposed to be having one later this week, but I wouldn't hold my breath. And by all accounts, 3 major hangups exist that have stalled and will continue to stall progress. The first of which, if you've read anything on stablecoins in the past few months, you've probably heard at this point, and that's the issue around stablecoin yield and its threat to bank deposits. So the Genius Act actually addressed this issue to some degree because it forbids stablecoin issuers from sharing interest with holders of their stablecoin directly. But then crypto exchanges found a loophole here to where they could pay what they were calling rewards, quote unquote, to those holders on their platform in the form of more stablecoins. So essentially stablecoin yield, just wrapped in sheep's clothing. However, included as part of the Senate Banking Committee's draft amendment back in January was language that explicitly prevented these crypto exchanges from offering stablecoin yield in any form. So this included the rewards loophole. This caused crypto exchanges and their political allies to immediately withdraw their support and postpone the initial markup session that was originally scheduled for late January. And like I said, that's still been postponed until today, We'll see. We'll see if this goes through later this week. But um, since that amendment, we have had a ton of smoke, but really very little fire in terms of something getting passed. At one point back in March, senators on both sides of the aisle announced an agreement in principle that would ban yield paid solely for holding a stable coin, but then permitting activity-based rewards tied to actual usage. And early on, this compromise appeared to have both industry and bipartisan support, but there was never a markup date that was announced. And then, not long after that agreement was reported, the President's Economic Council advisors published research that claimed a stablecoin yield ban would have little to no impact on banking lending in an attempt to undermine the banking industry's core argument against it. So personally, I was really surprised by the release of this report because one, it seemed like discussion on this front was already headed in the direction that the executive side wanted. Then it also drew a significant line in the sand on where the executive level stood. So this would inevitably add fuel to the fire in the camp of those who want to apply a blanket yield ban. And then three, the report said nothing about how bank lending might be affected if stablecoin yield was permitted, but instead it just said how bank lending wouldn't necessarily benefit if yield was banned. So whether this was intended or not, I'm still not quite sure here, but this report really sounded the alarms and gave the banking trade groups the ammunition that they needed to put on a full court press against any kind of compromise. So back on Friday, May 1st, we finally received the proposed compromise language that was teased in March. That following Monday, last Monday, not even a full workday had passed, and trade groups representing banks of all sizes, so that includes the Bank Policy Institute, the ICBA, the ABA, among others, they issued a joint statement that categorically objected the compromise language. So to me, given the fact that you have the Bank Policy Institute, who represents the largest of banks, fighting on behalf of the smaller and mid-sized banks, that signals that this deal is really nowhere close to getting done and will likely stall through the August recess, at which point Congress will be in full-blown election mode until the midterms arrive. And then beyond that, the Senate may no longer have the sheer numbers that they need to get something passed. So I did mention that we have three major hangups that are cause for concern. Real quick on these other ones, beyond the stablecoin yield question, also included in the Senate Banking Committee's amendment language was a provision tied to software developers and infrastructure providers who do not custody or control funds. So the provision states that those operating in this manner are not money transmitters under the BSA. So law enforcement groups, which included the National Sheriff's Association and the National District Attorneys Association, they raised concerns that this language could limit their ability to pursue financial crime cases. And to today, a compromise still has yet to be reached either. And then lastly, assuming that we do get a compromise on all of these lingering issues, and for the record, these are just the two biggies. So there's still some unresolved issues that include conflict of interest provisions for government officials and their families that I've somewhat alluded to here. But assuming that we do get a compromise, what some people don't realize is that there is actually a separate but parallel bill called the Digital Commodity Intermediaries Act that was drafted and passed the Senate Ag Committee back in January. So this bill focuses primarily on CFTC authority over digital commodity markets and will need to be reconciled and merged with the Senate Banking Committee's version of Clarity before the combined version is then reconciled with the House version. So all those steps must be completed before a final version eventually finds its way to President Trump's desk, which, if there's any language that restricts his family's crypto businesses, will most likely be a non-starter. So yeah, I'm not a betting man, but if I was, I'd probably be betting the house on not seeing this thing get done this year. And if that does end up being the case, that will put a massive damper on any immediate growth in stablecoins, because I do think institutions will continue to wait for more structure before getting into these things. However, despite Clarity's troubles, there has been other more positive news on digital assets policy. So on March 23rd, the SEC and CFTC published joint interpretive guidance that established the first formal token taxonomy for digital assets. It also addresses how a digital asset that is not itself a security may become subject to or cease to be subject to an investment contract. And then it also clarifies the application of existing federal securities law. So the way that stablecoins are addressed here, payment stablecoins are generally treated as commodities, while yield-bearing stablecoin products, should they exist, may end up falling under securities law. So all that to say, even though this is just interpretive guidance, we are starting to receive some understanding as to how these regulating bodies might apply what's expected to pass given the current clarity language. Nothing codified yet, but the agencies are trying to harmonize their approach even before the Congress vote. Elsewhere, federal regulators have issued multiple proposed rules in recent weeks to implement the Genius Act. So on April 3rd, the Treasury Department released its first proposed rule that establishes principles for determining when a state level regulatory regime qualifies as quote unquote substantially similar to the federal framework. So the way the Genius Act reads, if you are a non-bank stablecoin issuer with 10 billion or less in outstanding stablecoins, you may opt for state level oversight rather than federal supervision. But the state must pass what the Treasury Department is calling a substantially similar test first. So the requirements for the state regimes to qualify are listed out in detail in that proposed rule. And the deadline for any comments here is June 2nd, so already only a few weeks out. Then on April 10th, the FDIC issued a proposed rule that established their framework for the institutions it supervises who are in the business of issuing stablecoins. So the rule included requirements related to reserve assets, redemption, capital and risk management, and then most importantly confirmed that deposits held as reserves backing stablecoins would not be insured on a pass-through basis to stablecoin holders. So this confirms that stablecoins will not have FDIC deposit insurance. However, it also confirmed that tokenized deposits that satisfy the statutory definition of a deposit would be treated no differently than traditional deposits. So to that point, I know there's appetite for a broader discussion on tokenized assets, as a whole, which would include tokenized deposits. Today, I've tried to keep this presentation, relevant to just stablecoins, but there could be a world where these webinars expand to include all tokenized assets further down the line. There's a lot of gray area and overlap between the two, so stay tuned. But as far as the FDIC rule goes, the 60-day window for comments on what they've proposed ends on June 9th. So if you have any opinions on the FDIC's interpretation, now is the chance to make your voice heard. And then the last proposed rule that I wanted to touch on, so this was released on April 10th as well. FinCEN and OFAC released a joint proposed rule that would treat stablecoin issuers as financial institutions under the Bank Secrecy Act and require comprehensive BSA and AML programs. So all those risks that we just discussed when entering the stablecoin space and what will be expected from a customer identification and due diligence perspective. So not just hearsay, but legitimate regulation that must be followed once these proposed rules become final. So that's where we're at in terms of developments over the past 2 to 3 months. I apologize, this update was very heavy on policy, but that's kind of what we're stuck with right now until there's a few more stakes in the ground with clarity. I do think things will really start to ramp up if Congress can get clarity over the hump, but right now that's just unfortunately easier said than done. So last thing I wanted to cover before I let you all go, I know we're running real short on time here, but at the top, I promised some answers to those I either spoke with at last month's conference or those that provided feedback through our survey. So what you see on the slide here is the first of my top 5 most fascinating asked questions list from those sources. By far the most common theme among those I've talked with is this question over whether stablecoins really do pose a threat to community bank deposits, or if all the hype is just kind of overblown. The answer here, I think, is really twofold. And it's a combination of 2 factors I think I've already covered to some extent. So to me, it starts with clarity and how this yield question gets answered. In my opinion, a stablecoin that earns nothing is not really a compelling alternative to an interest-bearing deposit account for most of your retail customers. But if clarity ultimately allows any type of yield-like product, There's some industry research out there that the bank trades have offered up that suggests this could draw hundreds of billions of deposits away from the banking system, and that smaller institutions would be the ones to bear the brunt of that impact. So it's why you're seeing the ABA, the ICBA, and others fighting this battle so fiercely in Washington, and in part why there was such a rapid response to the compromise language. From there, I think it comes down to the sophistication of your customer base. So when I've asked members whether they've started getting questions about stablecoins from their customers, I'm not sure I've received a yes yet. And that's not to say that as these other use cases grow, that day isn't coming. And I think it's important to be doing more frequent studies and stress testing to understand your vulnerabilities. But right now, and I'm sure there's plenty of you on this call who can attest to this, but I think the bigger deposit threat exists in the growing use of the Venmos and the Cash Apps, the Schwabs and Fidelities, the sports betting apps. So, those right now I think should be of greater immediate concern. And, the place where I think institutions need to be focusing their attention, if they're going to try and mitigate some of this deposit erosion, especially as their customer base continues to age and starts to pass down their wealth to a younger generation that is far more digitally inclined. So the second question that I've been getting has been largely revolving around differences between a stablecoin and a tokenized deposit, and where institutions should be focusing their attention. So from the outside, these two can look nearly identical, but legally and structurally are very different. So where a stablecoin can be issued by any licensed stablecoin issuer, be that a bank, credit union, or otherwise, and then is backed by reserve assets held separately, which in many cases is a deposit that is now locked up and can no longer be used as such. With a tokenized deposit, you simply have a traditional deposit that is now represented as a digital token on a blockchain. So here you get all the benefits of being on chain. They're frictionless, they're low cost, they're programmable, but with the peace of mind that comes with a more clearly regulated and insurance protected product. However, the major drawback for tokenized deposits is that they're what's known in the digital world as walled gardens. So this means that they can't move as freely between different users and platforms as stablecoins. So if I have a vendor who doesn't use my same banking partner, I'm not necessarily going to be able to pay them with my institution's deposit token, where I otherwise might if both were able to transact in stablecoins. I will say that the interoperability here is improving, but it is by no means a seamless process yet. So if you're looking to stand up your own tokenized deposit, you'll probably end up seeing more utility in the form of the operational efficiencies that we discussed, rather than some of those more customer-facing opportunities. So again, stay tuned here because I expect we'll be doing some more holistic education on tokenized assets. And this could include things like tokenized securities, tokenized loans. We're even seeing tokenized livestock. So examples of all of these are growing, and something that I think warrants greater attention than most of us are giving it right now. Third is kind of related to this last question and deals with this concept of central bank digital currencies, or CBDCs. At one time, this seemed like the direction that we were headed in terms of a digital dollar, but there really hasn't been much, if any, discussion on the topic recently. For those that aren't aware of what a CBDC is, this is again a blockchain-based currency that, rather than being issued by a private entity, is instead issued directly by a central bank. So for context, there's roughly 75 CBDCs across the world that have either launched or are being piloted. That includes China and the European Union. They are in the late stages of their own pilot programs. And then another 60 or 70 countries that are actively exploring a CBDC option. But as of today, the United States is not one of them. So the current administration has been explicitly opposed to pursuing a CBDC, and actually issued an executive order early last year that directed agencies to not promote or develop one. So there may be some personal motivations driving that. I'll let you be the judge there. But by all accounts, until we get a new regime, oh boy, I just lost some light. Give me 1 second here. Oh, there we go. Forgot I was in here. Yeah. maybe some personal motivations driving that. But for right now, CBDCs have been put on the back burner while making a dollar denominated stablecoin, a universal currency has become the priority. And then fourth here is what stablecoins actually exist on the market today, and which ones I think are worth paying attention to. So the answer here really is the two stablecoins I mentioned earlier, and that's Tether's USDT and Circle's USDC coins. So together they account for the vast majority of the current market, with USDT holding the larger share globally, while USDC is more prominent here in the US. So for you all, I think USDC is generally the more relevant coin to understand. Circle is a US based company that has generally been more transparent about its reserve composition and has more actively engaged with US regulators throughout its existence, which makes it more compatible with the compliance expectations that your institution already operates under. USD, on the other hand, while larger by volume, has historically drawn more scrutiny over their reserve quality, their transparency. It's typically used more in offshore and emerging markets, and it's also headquartered in El Salvador. So actually, because USDT's reserve quality was not quite up to standard when Genius passed, Tether actually launched a separate Genius compliant coin called USAT earlier this year. But the market cap there is only like 150 million, so barely puts it in the top 50 in terms of total coins outstanding. Some of the other more recognizable coins are PayPal's PYUSD, Ripple's RLUSD coins. But if you're looking to get into stable coins, my suggestion would be to start with Circle and USDC. And then I'll close out the last of these questions here with a bit of a teaser for the reference guide that I'm developing. So like I said, we talked about this to some degree in April's presentation, but for those of you who weren't there, the other big question I've been getting is what concrete steps institutions should be taking right now, even if they're not quite ready to participate with stablecoins. So above and beyond the education piece that we've been hammering home here, I'd suggest assigning an internal point person to monitor developments. Make sure that you have somebody in-house who is keeping an active eye on these things, because regulation progress is changing daily. And so having someone tracking these milestones will help keep your institution from being caught off guard. Second, have a conversation with your core banking vendor. So understanding what your existing tech stack can already support, really costs you nothing, and it may change the calculus of your timeline in getting involved with these things. Third, I suggest that you review your existing BSA, AML, and vendor management frameworks. And then as you're doing your stress testing, keep stablecoins in mind. So even if you never touch a stablecoin directly, your customers might, and your policies and your potential vulnerabilities should reflect that. And then lastly here, as you continue your education, make sure that you're also educating your boards too. So regulators expect your boards be informed on these emerging risks and technologies. So even if it's just a brief overview at your next meeting, for right now, I think we're at a place where that's a reasonable and proactive step to be taking. So last thing that I want to leave you all with here is, I know I'm really running over on time, but this is the list of what I'm calling the frightening asked questions. So these are 5 open questions that I keep coming back to, and for which I've either not found a great answer, or my supposed answer genuinely scares me. Like I said, I'll have my contact information here on the last slide. So if any of you have answers to these questions or want to chat any further on them, my inbox is open. But starting with the role of AI with stablecoins and what it can mean with the development of agentic finance. So with agentic finance, you have these systems that are executing transactions completely autonomously, and without any human intervention, which to me logically leads to stablecoins being their currency of choice, given this programmability, and instantaneous nature. Then as more assets become tokenized, I expect that this will be the preferred investment instrument of these AI agents. So what does that ultimately mean to our back office and our treasury operations? I wonder, do do they become completely hands off? And if so, are we comfortable living in a world where that's the case? If you ask Mark Cuban, based off an interview that he did last week, he'll tell you that this is an inevitable reality. So it's got me wondering things like what skills and capabilities should we be developing at our institutions now so that we're set up for success when this is how the more operational side of things, eventually gets done. My next question is kind of an offshoot to this and centers on stablecoin based lending. So specifically, what would happen to the traditional banking model if this were to ever occur at scale? For the most part today, we've really only discussed stablecoins as a payments and settlement tool. But what would happen if stablecoins also became the vehicle through which on-chain lending occurs? Where through these smart contracts, things like originations, disbursements, and servicing all occur without a banking intermediary. There's a disintermediation risk to this line of business that's really the lifeblood of a lot of community institutions today as well. And that's just kind of scares me, I'm not gonna lie. I apologize. I know these are all pretty existential questions, but stick with me. We're almost done. On this third one here, I'm curious, what happens if we have another financial crisis and all of these fiat-backed stablecoin holders all rush to redeem at the exact same time? Will the issuers of these stablecoins be able to honor redemptions if what were once considered liquid assets are all frozen in now failing banks or suddenly illiquid markets? And then, how does the 24/7 instantaneous nature of stablecoins actually worsen this issue? So right now we see this always on light speed aspect of money as more of an opportunity than a threat. But it's situations like this where I could see it becoming a massive liability. This next one here is a question that I'd personally love to get some feedback on, and that's what do you expect of us, your Federal Home Loan Bank, in terms of stablecoins or tokenized assets? So whether that's our ability to accept your tokenized loans or securities as eligible collateral, or what if we were to issue our own stablecoin or tokenized instrument, be that a tokenized advance or tokenized debt? Are these capabilities that you're looking for? And then, what would be the expected timeline for something like that? And then last one here, and then I'll promise to stop giving everyone heartburn, but looking more long term, I've been wondering, this could be 5, 10, maybe 15 years down the line, but will stablecoin even be a word that we're using? Or will the distinction between stablecoins and traditional money just simply disappear? So will we blend to a point to where the line between a dollar in a deposit account and a dollar on a blockchain becomes so blurry that it's just eventually irrelevant? And if that's the case, are we even asking the right questions right now? So instead of asking what do we do about stablecoins, should we be considering things like what kind of institution do we want to be, or should our institution what should our institution look like? And then when money is acting and moving like everything else on the internet, these questions are things that really do scare me. So for now, I'll leave you with that parting thought. I know we're already a bit over time here. I haven't seen any open questions go by in the live Q&A as we've been at it here. But on the screen right now is my email address. It's my first and last name separated by a period. So sam.thomas@fhlbtopeka.com. Write this down, take a screenshot, whatever you need to do to get that saved. I don't want anyone who has any questions potentially to have those go unanswered. So please reach out with any questions that you may have after today's presentation. As I also mentioned, we have a stablecoin reference guide that I've been working on. So please also drop me a line if you have any interest in that. So I want to give everyone a chance to get this marked down. Sorry that we went a little over time here. It's been my pleasure to speak to you all today and peel back the curtain a bit on what I think is a very fascinating and still very evolving topic. Really do hope that this is just the first of many more webinars or educational pieces that we do in this space.